You are listening to the ESG and Coffee podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.
The world's environmental problems bring forth massive investment opportunity. Sustainable investing, to me, is recognizing the environmental input, but preferably an output of a company. So in other words, what is the environmental footprint? What are their actions like with regard to the environment? But more importantly, what are they doing as they deploy their, this is 130 words, deploy their technologies across their customer base to mitigate things like climate. Well, the biggest mistake I think we made was assuming that investors were ready for climate solutions 17 years ago. So I've been at this with clean tech for 17 years. It's been a long haul. We are very early on this. So I think that was somewhat of a mistake. We've been extremely patient, but I think we're becoming more and more constructive the last several years. I feel that we're investing with GEOS in a very inefficient portion of the capital markets. And so that inefficiency, it's really hard, and I can make a very strong case. It's hard to ETF clean tech. I believe our 9 themes, are much more diversified than the bulk of the ETFs that are out there. I think a lot of asset owners have forgotten what they own. So know what you own. It's hard to know what you own when you own an index fund. We've been doing work on hydrogen the last 3 years, and we bought a few companies around hydrogen. The hydrogen economy is here. So my thesis around that was garnered at an academic conference. MIT is right across the river from us in Harvard. We go to a lot of conferences there. Greentown Labs is in Somerville. So this is where we come up with the thesis on what's the technology, and then we do the heavy lifting on what are the companies we can find around this potential new technology. It has to be commercially viable for us to invest. So by commercially viable, what I mean by that is it has to be profitable. What's known as EBITDA margin profitable. It has to be profitable, and it has to have positive cash flow. That's a sign of commercial viability. But also, you need to have what's known as the tipping point. And so adoption has to be happening widely in the market. Tipping point isn't here for hydrogen, but I believe it's coming rapidly.
I first met Bill Page in Boston sometime around 2005 when I was investment research product manager for KLD Research Analytics, taking our ESG research to the investment market. And Bill was at State Street Global Advisors as head of ESG, where he was for a decade. In today's ESG and Coffee episode, please listen for how Bill and his team used to have to explain what clean tech was, and now he's able to go straight to the investment thesis when he's meeting with investment client prospects. Bill was fortunate to do what few others have: take his strategy with him when he left the old firm to go to Essex Investment. The Global Environmental Opportunity Strategy, GEOS, has clients who are, quote, high-impact investors, from family offices and endowments and other institutions, as well as registered investment advisors. GEOS uses 9 themes covering the range of, quote, solutions, unquote, to the world's great challenges. It's a concentrated portfolio of 35 to 45 names and uses impact management tracking with proprietary metrics, including on the big themes of carbon avoided and water saved. GEOS' focus is on clean tech listed companies of any size market capitalization, which Bill describes as an inefficient part of the market with lots of mispricing of companies and crazy valuations in markets has been swinging, meaning Bill has to be solid on his own valuations. I push Bill both on thinking about the Sustainable Development Goals not as a smorgasbord to cherry pick from, but as a cone stack built on a healthy biome, following the work of the Stockholm Resilience Center. And I'm a little surprised on how his shop is not doing the best job tracking their own footprint. Listen for Bill's takes on how many investors have forgotten what they own, how Cleantech 3.0 has been running since 2019 and does not care who is in the White House. That was pretty surprising. Listen to how it's been a, quote, long road, unquote, for someone early, too early perhaps, into clean tech investment. That's years of experience speaking on the interview today. We could have spoken for another hour, and I look forward to doing that perhaps on the bicycle this fall. Here's my live to Zoom tape interview with Bill Page. This is what a quality, long-form conversation on investment and ESG sounds like. In this episode of Season 1 of the ESG and Coffee podcast, the season called The Originals, I'm pleased to welcome to the ESG and Coffee podcast one of the originals making ESG positive investment happen. Bill Page, Senior Portfolio Manager, Essex Global Environmental Opportunity Strategy, GEOS, at Essex Investment Management Company, LLC. Please check the episode note for more. We'll post more details as always. You can find Essex on Twitter at Essex Invest. And Bill's LinkedIn profile is as follows, quote, joined Essex Investment Management in February 2009 to relaunch the Global Environmental Opportunity Strategies, GEOS. GEOS was designed over a 3-year period as I headed the Environmental, Social and Governance Investment team at State Street Global Associates. I'm working with a strong and experienced investment team at Essex on a long-standing growth investment platform at a venerable firm founded in 1976 by Joe McNay, CIO. He is a member and investment and proxy voting committees, and his specialties are direct environmental investment research, investing across multiple themes in the global public equity markets. Welcome to the podcast, Bill Page.
Thank you, Graham, for having me.
It's great to find you well. Where in the world are you today, sir?
Yeah, so we are Essex. We have 2 locations. We're based in Boston and Evanston, Illinois, right out of Chicago. I've been holed up in my home office and intend to stay there until we have a formal opening. So I'm based in Concord, Massachusetts, which is northwest of Boston, in the home of Henry David Thoreau. So we have a lot of environmental centricity to Concord, Massachusetts.
Very nice. And you're not far from Walden Pond, or they used to be on one of my bike routes past there.
Walden Pond is 2 miles away, and we have tremendous conservation areas in Concord, which I enjoy with my corgi Peter and my wife, and so yeah.
Excellent. We need to get cycling again on a different day.
We do, yeah.
Right. So first call at ESG and Coffee podcast. If we were at your local coffee shop, and I used to stop at the cafe in Concord, Mass, I think. So if I was at your local coffee shop, I'd head up to the counter. What would I order for you, sir?
Well, I actually just had my first, probably second cup of coffee last week. Ordered, out at a cafe, and I was down in New York for my son's graduation from Tisch at NYU. And I went to Stumptown, which is right near Washington Square. Phenomenal coffee, and I had a cappuccino with oat milk. So I've been an oat milk convert the last several months.
Really interesting. I can't get there. I did try, but I can't quite get there on oat milk. Give me your 20-second take on drinking milk from oats.
Yeah, so I've gone almost full-on vegan for mainly environmental purposes in the last year. Another benefit, one of the few benefits of COVID is more, for me, centricity to diet, and given climate, given animal husbandry, I've moved mostly all focused on plant-based foods. And so right now I'm having iced coffee with oat milk. And so oat milk is got some sweetness to it. It's higher fat content than some of the other alternative milks. But the key to it for coffee is it froths very well. So in my frother in the morning, it comes out almost as well as any regular cow's milk.
Excellent. That's one of the better pitches I've heard for oat milk. Still not going to try it this week, though. Good man. Let's move forward then. I like to start with very, very big picture, the tragedy of the horizons. So Mark Carney famously spoke of the tragedy of the horizons when he was governor of the Bank of England. At the time, he was also chair of the Financial Stability Board, these big organizations that manage how the financial system works. He was at Lloyd's of London, the famous insurance reinsurance house. This is back in September 2015. He spoke about, quote, while there's still time to act, the window of opportunity is finite and shrinking, unquote. So I reflect well on Sir David Attenborough's movie that he released on Netflix, Our Planet, Did you watch that, by the way? Did you
I
get
did. Yeah, I thought it was outstanding.
Yeah.
Yes.
And so in that, Sir David references 2 data points, and I've asked you to go ahead and add a third. So the 3 data points. So let me ask you, and we like to date them back to your first career paycheck, which you don't have to tell us. Happy to hear it if you have. Some guests have, some guests haven't. So dating back to the year of your first career paycheck, how much is each data point? So here we go. World population.
Yeah. So I did some research here, Graham. So world population was almost 5 billion.
Okay. S&P 500.
Believe it or not, it was 560.
Wow. And carbon dioxide in parts per million.
Yeah. So this is interesting. 345 ppm.
Wow. Below that magic 350 number. So for reference for our audience, population today around 7.9 billion, S&P 500 at 4,188, and CO2 equivalent around 418 parts per million. Bill Page, how did it sound? How did it feel to see those numbers come up on the screen and to hear them now?
Well, I think population is interesting because way back we were concerned about overpopulation, and I think that's a lesser issue today. I think we're more concerned about demographics and the shift of population density. And what I mean by that is that given the demographic changes, do we have the ability to harness and feed the new regime of more urbanization? On the S&P, the equity market has been incredibly successful the last 35 years. On CO2, it's interesting. When you think about massive shifts on increased intensity of CO2 and the impacts on the Earth, it's becoming more asymmetric. And so we're getting much stronger impacts in the last 10 years than we had back then. So to me, that's quite concerning. And even if you look at Paris Accord, I don't want to get off track, but we can do better. We need to do better faster than those intentions.
Yeah, fair comment. Okay, let's jump in then with our first set of espresso questions. We have 4 sets of espresso questions. Here we go with set 1. You ready, sir?
Yeah, I'm ready.
All right, here we go. What is your earliest memory of investing?
As a child in middle school, bartering for either pencils, pens, or stickers for our bikes. And the price was the intrinsic value of the goods we were bartering and exchanging.
What kind of bike did you have?
I had a Schwinn, and it was
With
really,
a banana
really
seat?
cool. It was a banana seat with yellow. So yeah, it was a canary yellow bike. Yeah.
That's a classic. What is your philosophy of investing in 1 sentence?
The world's environmental problems bring forth massive environmental opportunity. I'm sorry, investment opportunity.
Nice. And what switched you on to ESG?
It was just during business school, and I left the financial industry pretty dismayed on some of the sales practices at the time. I wanted to go up and work where you have ties in Vermont, potentially for a company like Seventh Generation. But I was convinced by a faculty member I worked for that I should look at maybe a firm called KLD in Cambridge. That's where I worked during business school for a year as an intern. It was a great experience.
When I was putting together the interviews for the original series, I was thinking about how many of the KLD alumni I might come across or look to shortlist. I may even just do a separate series on the KLD alumni because they're some of the originals. How do you choose to define, quote, sustainable investment, unquote, or investing with ESG factors in less than 30 words?
Really tough, Graham. So sustainable investing to me is recognizing the environmental input, but preferably an output of a company. So in other words, what is the environmental footprint? What are their actions like with regard to the environment? But more importantly, what are they doing as they deploy their, this is 130 words, deploy their technologies across their customer base to mitigate things like climate. ESG factors, investing with ESG factors is to me more institutional. It's engaging in incorporating ESG as a risk mitigator, but also an alpha generator.
We will set you the homework assignment, so please have it in by Monday. Um, what is your biggest investing mistake so far?
I think the biggest mistake I think we made was assuming that investors were ready for climate solutions 17 years ago. So I've been at this with clean tech for 17 years. It's been a long, long, long haul. We are very early on this,
Mm,
so I think that was somewhat of a mistake. We've been extremely patient,
mm.
but I think we're becoming more and more constructive the last several years.
Excellent. I wish for you a hockey stick of AUM. Right, let's head into the first of our three big deep dives. Deep dive one, we'll just start with the very basic. What does your job title mean, and what is not your job? Co-portfolio manager for Essex Environmental Opportunities Fund at Essex Partners. Don't know if I got
Yeah,
that right.
so we're just a little bit about Essex. So we're a fairly entrepreneurial boutique. So the firm is 8 people on the investment management side, and then we have several people in trading and operations and compliance. And so we're all wearing several hats, and so it's not like a big monolithic firm. So while my title is senior portfolio manager, and so my partner Rob Buick and I are co-managers for the GEOS, the strategy, which is a listed strategy. You'll learn more about that in a minute. So we're managing money, but we're also doing a lot of blocking and tackling, writing, educating the market on what impact solutions mean. We do a fair amount of marketing also. So we're a small firm, and not a lot, no bureaucracy. It's 100%
That's a good
focused
one.
on investment management.
Yeah, that there are definitely strengths to being the boutique. And then again, just helping situate for our audience, range of people around the world, different roles. And if we had to simplify the investment value chain into a group here that owns the money, a group that gathers assets, a group that manages those assets, a group that does the research on investment opportunities, or someone who's influencing the whole investment value chain in some way. Which piece would you say you personally do?
Yeah, we're focused exclusively on managing the assets
Mm-hmm.
and also on researching those the companies that make up the assets that we manage. So we're what's known as institutional investment managers. So we're focused 100% of the time on institutional money management, and then our clients are companies that help gather the assets.
Got it. And then I enjoyed arriving on your website and seeing your strategy up front, right above the fold. That was great. And the sentence went something like, "How impactful is your portfolio?" Essex Environmental Opportunities Fund, and then gave the ticker and so on. So, How did you land on that motto or strapline? How impactful is your portfolio? Why did you choose those words?
Yeah, the reason, so I do believe you can have, I don't want to fight with direct investing. So direct investing is obviously you're not in the listed markets, right? So it's a more inefficient capital market structure. But when people think about impact investing, they tend to think about direct private investing. And I believe you can have as great, or in many cases, a greater impact by investing in the listed market.
Hmm.
And so how impactful is the fact that we believe, and this is a client that said, we peg the dial on impact.
Mm-hmm.
And we'll talk more about how we define that, but one can have a high impact in the listed market. You just got to make sure you're in companies that are investing around solutions.
Excellent. Okay, so let's build on that then. So could you explain the philosophy of the strategy? And I picked up a quote here from your materials. It said, GEOS investment strategy philosophy, quote, invest in clean technology solutions to environmental mega trends. And you went on to quote one of the Rockefellers. I can't remember if that's the Rockefeller that helped put the money into the Woodstock, Vermont area, which I know well. But he said, quote, the opportunities take the shape within the problems, unquote. So can you just unpack for us a little bit the philosophy that you have?
Yeah, the philosophy is very simple, and the issue is our world faces massive challenges, and we believe that the climate challenge is the greatest challenge of our generation. and will be the greatest challenge in coming generations.
Yeah.
And what's interesting when you think about climate change, there's a lot of other ancillary complexities, social, civil. We learned about this during COVID, right? COVID was caused by deforestation. So when you think about all of these issues, all these problems can be solved by investing in the companies that can abate all these challenges. And so that in pure terms, that is our philosophy, is that there's massive challenges globally, and let's invest in the companies that are positioned to solve these challenges.
Okay, great. And as with any business or proposition, you're always looking to define your edge. What makes you different? What makes you special? So let me put that to you. How would you explain what is the GEOS edge?
Our edge is that we invest in what's called clean technology. And so clean technology, we invest, the first edge we have is it's thematic. So we've invested across, it's a proprietary structure of 9 themes. These 9 themes are all tied to abating climate and other issues like water. And the beauty of having these 9 themes is we're not a monolithic central research shop where we may come up with an idea and then vet that idea with preconceived notions of how the GICS, so the industry classifications, work.
Right.
The beauty of thematic investing is that the solutions around clean technology are multiple and varied and coming at us very quickly through disruptive technology. And so we've been, the second key differentiator is the way we harness this thematically. Secondly, the domain expertise. So we've been at this, my partner and I, for over 34 years, combined experience following clean tech. So we've seen each of the clean tech cycles, and we have very good methodologies in how we evaluate the industries that make up the theme and then the companies within the industries. And so it's called a solutions-oriented approach in very high impact. So the edge is the domain expertise, and the last edge we have is that we're very pragmatic. And so we invest over the long term. And so that's reflected in a long-term investment thesis in very concentrated portfolios around companies that are known as small and mid-cap. So these are companies that have pure expression to the philosophy.
Excellent. And in Deep Dive 2, we're going to unpack a bit more on the metrics that you have for those themes. So I look forward to unpacking that a bit, and also the horizon. But this ties to something I saw you post recently, I think within the last half year or so on LinkedIn. It was called Disruptive Tech Does Not Care Who is in Washington. Originally, you had posted on the 7th of April, 2017, and then you reposted it. Could you just give us the highlights? I will connect to that in the show notes. But just what is the big idea behind that that paper or thought piece you put out?
Yeah, there's a lot of misperceptions about clean tech, and some of these misperceptions do lead, we believe, to a very inefficient portion of the market. And one of the biggest misperceptions is that, and even folks that focus on ESG investing get caught up in it, is that you got to have someone who supports carbon or clean tech in the White House to enable these technologies to be viable. And so what's interesting is in the last administration, where one could make the point that we didn't have as much support as we could have in the current administration with President Biden. But over the last 5 years, clean tech has completely matured. It's moved from what I call clean tech 2.0 to what's known now as clean tech 3.0 by my definition, which started in early 2018. The reason why these technologies are becoming, the J curves are hitting, meaning that they're growing, they're becoming commercially viable, is the fact that the technologies make sense. The costs are coming down, whether it's LED lighting or solar or battery technology. And so they make life easier, they make commerce run more efficiently, they save resources, and they make life more enjoyable. When you install smart traffic lights when you're running to work, in a smart city infrastructure, it improves the livability of that city and lowers pedestrian death. So that's a strong return for clean technology. And so the reason why I reposted it is that I think I reposted it during the election, and the point was that despite the outcome, we're still going to have, we believe, massive growth opportunities around clean technology.
I think it's a really useful framing, especially for those outside the US. Many investors doing many important things outside the US, but it also helps kind of situate what can sometimes be quite a confusing mixture of 50 states making decisions, and then at the federal level, decisions get made, and then of course there's the international level. So I think really useful piece. Thanks for that. Let's jump through quickly on some other just very basic items. So someone likes you, I know how to buy a cup of coffee, but how do I buy a cup of Bill Page? How does one buy your investment service?
Yeah, so at Essex, we run what's known as separate accounts, and those separate accounts are for institutional investors. So the institutional investors are, it could be a pension fund or a foundation or endowment. We also run assets for what's known as high net worth. So these are family offices. There is a mutual fund version of GEOS. For compliance purposes, I can't talk about the fund, give the ticker. But if you search on the essexinvest.com site, which is our institutional site, there's a landing page for the mutual fund. The mutual fund it's run pari passu. So it's the same investment strategy that we run on the institutional side for GEOS. So our personal book of business for GEOS to date has been what's known as high impact investors. So family office, small foundation endowment. And then on the mutual fund side, our clients are registered investment advisors, what's known as RIAs. And so they're investing on behalf of, again, institutional investors, or it could be individual investors. And then we're seeing more interest from larger asset owners, so larger institutional clients currently.
Okay. And then one more question on the business of investment. So how do you decide how to price your investment service? Like how do the fees get set? And do you guys, for example, use performance fees, which some boutiques and even some of the mega firms are using?
So what I will say is I believe there's a fair amount of fee compression happening in the institutional investment space. This is my own personal opinion.
Mm-hmm.
I think that fee compression has done a bit of a disservice to the fundamental investment world. When you think about the growth in the ETF and index business over the last 10 years. And so I feel that we're investing with GEOS in a very inefficient portion of the capital markets. And so that inefficiency, it's really hard, and I can make a very strong case, it's hard to ETF clean tech.
Mm.
I believe our 9 themes, are much more diversified than the bulk of the ETFs that are out there. I think a lot of asset owners have forgotten what they own. So know what you own. It's hard to know what you own when you own an index fund. And so people use GEOS in concert with a large cap strategy. It could be a large cap growth strategy.
Mm-hmm.
The ESG space too is also undifferentiated. Many of the large cap ESG managers own the same stocks that these large index funds have. So we're in a much more inefficient portion of the capital markets, where I believe there's also more return opportunity. So in that, yes, indeed, we price higher than the index funds, but I also think bear in mind that this is inefficient. We do not have performance fees for GEOS. Essex, we do run hedge funds where there are performance fees.
Got it. Okay. And then in terms of meeting the market, and you spoke earlier about that's not really your role, but clearly you're going to be having pitch meetings or demonstrating to people what you do. So what are some of the easiest parts of that conversation that you're having in 2021? And what are some of the hardest parts of that conversation that you're having?
Yeah, it's been a long road over the last, so I came up with this idea when I was at State Street Global Advisors. And when State Street got out of the fundamental investment business, my partner Rob and I took this to Essex in early 2009. And so in the early days, we were out educating. We've been educating the market for years. And so it's educating consultants about what high impact is, what thematic is, what secular trends are. When the market only wanted to hear about ESG and climate risk, I felt like I was speaking a foreign language because I'm trying to talk about opportunity and climate solutions. And so very few consultants and asset owners were talking about climate solutions even 5 years ago. That's all. and so it was frustrating. But then I said, well, let's try to incorporate what we're doing in using the metrics of ESG. So we are about the high E environmental solutions. We're not blind to the S and G, right? But now I'm finding that the market's completely come around. And so the beauty of the domain expertise in the years we've had, our composite is now 12 years, is we've been at this a long time. You can't, we've got massive domain expertise, I believe. And so now we're finding that we have less hurdles. So when I was in a consultant meeting 6 years ago, 3/4 of the meeting was spent not on our process, it was spent on what climate is, why it's an opportunity, why we need to move beyond risk. Now the market's completely come around to the idea of we need to invest in the solutions. So it's easier today than it was. And there's a lot of misunderstanding about clean tech. You know, that Solyndra thing. I mean, come on, we lived that for years. So that's believing that every company is solely dependent on government support. Clean tech is completely matured in many different segments of the market. So now, you know, people are believers in the adoption rates of many of the clean technologies.
Okay, very good. And then I saw recently you were at an event by Intentional Endowments Network. Is that Mark Olowski's shop? Where?
No, IEN is headed by a gentleman named George Dyer. And so Mark Olowski, I do know, he's Mark works with college campuses on energy efficiency education.
Okay.
So IEN is made up of asset owners primarily in the higher ed realm. And it's really a platform to talk through their affiliate Second Nature about sustainability initiatives on campuses. And then IEN helps bridge the initiatives on campuses into the investment office. So we did a presentation on climate solutions, and so I had a panel. We had a consultant, and we had another. We had a private equity firm, and I talked about listed equity.
I had a recent interview with Seb Bilo at WHEB Asset Management in the UK, and they've just recently, I think within the last 2 years, crossed over the magical $1 billion AUM mark. I understand Essex is just under that as of today. Is that fair?
Yeah, we're at about 850 at March, and so we are just about 850, and then GEOS, we're about 75 million AUM for GEOS, and so that's a mutual fund in various separate accounts.
And can your strategy scale? I mean, if you say you had someone showed up with $1 billion, I wish it upon you. Could you accommodate that, or would you hit constraints? You're in the listed market; it shouldn't be a problem, right?
Yeah, so we can. Our capacity for GEOS is about 2 billion. Okay. And so, so we have 2 billion of capacity. We are in discussions with some large asset owners about capacity. And we also have a plan, my partner Rob Yoke and I, to build an entire firm around and enhance other strategies. And so we could do a larger cap version of GEOS. This is all on solutions and outputs. We could do water. So these are some other examples that would help us scale the business.
Sure. I wish you more strength, and best we get that bike ride in before you get even more busy. Let's jump into some other basics around the ESG factors that show up in your approach. So first up, if I had to say ESG factors, how do they factor? How many humans at the shop work with ESG, and how do ESG factors show up in investment committee decisions?
Yeah, so we're all humans. We're not a quantitative shop, so there's no black box. ESG to me, and this is something that we just signed the PRI the first time. It's a massive effort for a small shop to do this. And so the PRI, it was an incredibly intense process. We chose to do it this year. So the first year you do it, once you sign, it's voluntary whether you submit. We submitted. And it was a massive undertaking. I believe the process is really biased towards towards larger firms. So it was a huge lift for us. And so we have completely mainstreamed ESG at Essex. And so we have a responsible investment committee, and there's 4 of us on that committee. And what we do in the committee, yes, indeed, it's a little bit centric during proxy season to proxy voting, but we are now voting in line with sustainability mandates across the entire firm. And so now bear in mind, the firm is geared more towards small mid cap. So proxy season is not a lot of Exxon engine number 1 type proxies and engagement happening here at the shop. But at the same time, it's a big lift. And so ESG is completely integrated. We have an investment committee, of which I'm on, and the IC meets 4 times a week. And frequently we bring up all of these issues. Now we tend to, because of the firm, we're a thematic firm, so we tend to think about themes, but how do we add it through stock selection? We're all about bottom-up stock selection, but we're always talking about the dynamic growth trends globally around clean tech. But what the PRI signatory process, what I learned from it is the fact that we're doing a lot on impact reporting for GEOS, and we want to bring that in line with our other strategies at the firm. And the other thing we're going to be working on is we don't want to lose sight of the ESG metrics as we evaluate a company. And so everything we're doing now is fundamentally, so if there's a governance issue, it comes up in the course of us our meeting with a company, but we really want to start to develop a more significant methodology and framework around evaluating companies from an ESG perspective.
Got it. And were you pulling your ESG data analysis from? Are you subscribing to feeds? Are you pulling them off for your front end from a Bloomberg or a FactSet or something like that?
So we are in the process with one of our vendors of doing some issues screening for the overall firm aggregated portfolio. We've already been doing that on the proxy voting side for GEOS, the strategy that I manage. ESG data doesn't exist for what we're doing. And so, I mean, I've been part of 2 major metadata analysis efforts when I was at State Street. And I studied an MIT release, metadata, checking all the data out there on ESG. And I looked at the results from an MIT study about 2 years ago, and it hasn't changed. And so the data is massively noisy. I don't have faith in most of it. That doesn't mean, but then again, that makes a market. And so, what I'm getting to is the fact that when I screen our portfolio, and I have access to this through Bloomberg, there's very little score on ESG on our portfolio. There's very little data, which is fine because it's small mid cap. That's where the focus is. There was an article on Bloomberg today just about that, about the lack of ESG data. That's just fine because the ESG data is subjective. We want to do our own digging, and so anyway, that's a long-winded way of saying that ESG does factor in very strongly. The other thing to remember is at GEOS, it's all about solutions. So when you have a company that is solving an environmental problem and it's small mid-cap, de facto in the DNA of that company, many of the other positive ESG metrics tend to line up. They're small, they're discrete, but we've had to build our own methodology around this, which I think is a competitive advantage anyway. So
I think that's the best way to learn. You have to build it yourself, right?
You do. I mean, we could have bought an ESG data stream and slapped an ESG score on the portfolio, but it would be meaningless. So again, getting back to the point that you made earlier about how impactful is our portfolio, these are, we believe we've got significant, strong methodology in how we've constructed the investment process.
Fair enough. Enjoy some of that oat milk infused coffee there for a moment. So one quick item, and then I want to come into land on deep dive 1. Carbon footprint analysis. I picked up some interesting work happening from Europe where the fund managers are actually trying to develop scenarios, map a carbon footprint through that, and then start to imply what temperature path that could mean for their portfolio. And one appreciates that that's a bit hairy, that's clearly intellectual, and there's a lot of assumptions probably roll into there. But have you looked at doing climate scenario modeling at all for your portfolios, or temperature modeling? Is that something you can do or would be interested in doing?
Yeah. So there was now a client, so a consultant who was doing work. The asset owner was extremely educated on climate output analysis, and they did work on us versus some of the other environmental solution strategies out there. And in their opinion, we sort of pegged the dial on.
That's an American phrase. What does that mean?
Peg the dial. We had a very strong perceived ranking on low carbon transition. So what we're doing on output analysis. So output analysis is basically how do you evaluate the impact that your portfolio is having? That's my definition. And so what we've integrated what's known as we're going to talk about a little bit, the SDGs, the UN Sustainable Development Goals. And then I'm working with a number of other impact initiatives. Iris Plus and GIN are working on some other initiatives. Mm-hmm. So we're evaluating them. I saw this a few months back. We are looking at it and evaluating it. I question the methodology a little bit because it's relying on what's known as an input-output model, which is an assessment. It's an estimate of the carbon for a company's operation. And there's also a segment of it that uses what's known as scope 1, 2, and 3 emissions,
right,
which gives me a lot of hesitancy because there's a massive amount of double counting on scope 1 and 2. So what we've chosen to do is we're engaging with each of our companies individually to get really comfortable with the methodology they have on their operations, so their own carbon footprint. But more importantly, as they scale their technologies across their customer base, what are they saving for carbon on the part of their customers?
Okay.
That's
Okay,
the
good.
framework.
So let me land then, and you've kind of pointed towards my question. Here I'm looking for a number, if at all possible. So the question is, what shadow or actual price for CO2 equivalent per ton does your firm use internally for your own operations? And do you have a shadow actual price for CO2 per ton in your portfolio companies? And this question is partly inspired by, even back in the day at KLD, we were trying to track stuff on a spreadsheet, and and all the way to more recently Swiss Re coming out and saying, well, we're going to start putting a shadow $100 per ton price for CO2 equivalents. So do you have numbers?
So the answer is this is a deep dive, Graham. So my hypothesis when I created GEOS, and I started designing it back in 2006, was that we were going to have a price on CO2 globally, and that price would be
Remember those days? We wished and hoped. Yeah,
5 to 10 years, right? Maybe even 3 to 5, and it hasn't come. CO2 pricing is still massively inefficient. The most constructive in this, I would defer to a good friend of mine, Alex Rao, on this on Climate Wedge. He's one of the world's experts on climate pricing, but EU's the most vibrant market. So fungibility, the other term is liquidity. So what's the best, most robust market where there's most fungibility? That's EU emission trading scheme. And so that's sort of where I look to see where are carbon prices, and they're low. They're still, what is it, 56 euro last time I looked. Yeah. And so you need to put a multiplier to get us to Paris Accord of, put a coefficient of 5 on that, right? So bottom line, I think shadow pricing is something that the methodologies and the constructs that enable it are too weak. So what we do is fundamentally think about. And so everything in our portfolio, we're fossil fuel free because we're investing in clean technology. Everything we do, these are, I believe, yes, indeed, there's a carbon element in budget to solar panel production, but we're helping engage with the companies on what are you doing for your operations? And then what's the output metric you're using as you deploy your technology, which is new energy, to the market, right? So it's all about output solutions. How much carbon and water are you saving? At Essex, in the investment committee, though, we have some larger fossil fuel companies in the portfolio. And so as we did our work on, we have a company in GEOS called Ørsted, which you probably know. It's the old Danish oil and natural gas. Ørsted was, in my opinion, the first energy company to announce we're moving to full-on renewables, the new energy economy. We're going to completely divest from coal-fired electricity generation and delivery, and we're going to completely divest from servicing jack-up oil rigs in the North Sea. That's the first company, really, by my mind, to do that. Oh. And so we did a work on what's the next Ørsted, and so we have what we believe the next Ørsted we own. So we own Ørsted and GEOS currently, as of March 31st, and currently. But we've done deep dives, and this came out yesterday with Shell and Exxon. So we think about what are the companies that are using their core IP, intellectual property, and expertise to move into the new energy economy. And so natural gas infrastructure, our energy infrastructure, we should leverage for green electrons. And so that's an idea. So many of these large companies are very well positioned. So I digress, but the point is that's a way to analyze a company from stranded carbon sort of perspective.
And so let me put a point on for your shop's own footprint. Are you guys running a spreadsheet? I mean, I know you would have been.
No, we don't. So we haven't done it. I mean, we could probably get it. I mean, we're 2 locations. You know, there's in the firm 15 people. It's at least 2 leased properties. You know, IT. So that's a good question. I can talk to our IT outsourcing company on how are they sourcing their power, and then we can easily get from our property owner. I believe we could get down to the square foot, but the answer is haven't done the work.
It's a fun intern project for the summer.
Well, I think it could be for our new. We're in the process of hiring an impact analyst. So maybe his or her first project could be long, or I think it'd be fairly low. The financial services industry, you know, we don't lend, right? We're only managing, and so I think. But fair question.
Fair enough. Good.
You are listening to the ESG and Coffee podcast on investing, strategy and sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
Good. Okay, let's change speeds here and jump to some fast espresso shot questions. Set 2. You ready, sir?
Okay.
Here we go. What app is Bill most likely to be viewing on his smartphone while waiting in line?
So it's either email, so Microsoft Office, or if I'm waiting in line, I use Evernote pretty significantly. So I could be going through a shopping list on Evernote.
Very good. What book did you enjoy reading recently?
So there's a author, esoteric. He's sort of a modern Henry David Thoreau writer who wrote The Outermost House. So back in the 20s, and so it was on the Outer Cape, and it got eventually washed away in a storm in the 1960s. But his name is I gotta make sure I call him Henry Benton, but it's Henry Beston. Outermost House. So, and he's a nature writer. So he wrote all the way through the 50s. He wrote about 8 or 9 really great nature books.
Wonderful. Well, thank you. We'll add that to the show notes, and I'll check it out. What is the best kind of pie?
Blueberry pie.
That is the correct answer, by the way. What is your favorite movie or on-screen moment that relates to the world of investing?
Yeah. So what's interesting is, it's a lightning round. So I'm going to go with Dark Water on PFAS.
Dark Water. I'm not familiar with that. Give me a snippet.
So it's a bit about the DuPont crisis around emerging contaminants. And so it came out, and emerging contaminants, the other word, the chemical use, one of them is PFAS, the abbreviation. And so these are micron level pollutants on so plastic, but also there's massive issues with chemicals and water supply. So even after the existing EPA, sorry, this is a lightning round, but even given the current EPA legislation, PFAS is a huge issue. So I always think about investing when I look at sort of environmental books or movies.
Excellent. As an investment professional, what has been your most meaningful success so far?
I would say the creation of GEOS. And so the ability to come up with what I thought was a high amplitude solution to solve environmental problems. And it's been a long haul, but we believe we are currently well positioned.
I think that's fair, and yeah, all power to you. And frankly, that's how you got selected for the first season of ESG and Coffee, the originals. So let's head into deep dive 2 now. Again, we're going to have a deeper look in terms of your portfolio and the strategy and some of your thinking. Let's start with an open-ended one here. Where do investment ideas come from?
Yeah, so for us, I'm running the Essex Global Environmental Opportunity Strategy, so it's GEOS for short. It has to be a company that solves an environmental problem, and it has to be, and we has to be mapped to one of our 9 themes. And so we have a proprietary database of companies. Believe it or not, there are over 700 companies in this proprietary database that all solve environmental problems. So they're all solutions oriented. It's all cap. We're focused mostly on small mid cap. Where do we come up with these ideas? It's as I mentioned earlier, incredibly inefficient portion of the capital markets, clean technology, and so it comes from following the sector for 17 years. And so it's talking to sell side brokers and analysts. It's talking to the private equity connections we have for forthcoming potential IPOs. It comes from industry conferences. It comes from academic conferences. And as we find these companies, we put them into this proprietary universe that we have. And at that point in time, that universe consists the constituents, so the members, the companies, the stocks in that universe. We map manually to one of our 9 themes. And so we could be out at an industry conference, find an idea, may or may not be in our universe, we'll add it. And so that's how we come at this. And so it's purely bottom up investment management, but we're informed by these 9 themes.
I've spent some effort over the years to feed into what's happening at NREL out in Colorado. Yeah. They're always looking for input from investors and the investment perspective. Have you ever picked up anything through that avenue?
Yeah, it's a great question. So we have a lot of academic affiliations. We do a lot of talking to the Columbia Earth Institute. And so, and these are basically ideas that, what's the pathway? That's how, I discovered. So I've been following, pun intended on that, by the way, Graham. So nice. Hydrogen, so we had hydrogen exposure years and years ago. But we've been doing work on hydrogen in the last 3 years, and we bought a few companies around hydrogen. The hydrogen economy is here. So my thesis around that was garnered at an academic conference. MIT is right across the river from us in Harvard. We go to a lot of conferences there. Greentown Labs is in Somerville. So this is where we come up with the thesis on what's the technology, and then we do the heavy lifting on what are the companies we can find around this potential new technology. It has to be commercially viable for us to invest. So by commercially viable, what I mean by that is it has to be profitable. What's known as EBITDA margin profitable. It has to be profitable, and it has to have positive cash flow. That's a sign of commercial viability. But also, you need to have what's known as the tipping point. And so adoption has to be happening widely in the market. Tipping point isn't here for hydrogen, but I believe it's coming rapidly.
And Kathy Woodshop, ARK Invest, one of their edges or one of their pieces to their special sources, they actually allow their analysts to get beaten up in public forum, whether it's Reddit or Twitter, what have you, by putting out some of their hypotheses, some of their big ideas. Where do you go, or how do you kind of polish your ideas by sharpening it against other people? Maybe you have opposite opinions.
So Yeah, so that's a great. So one is having a great co-manager. So Rob Yoke and I, do all of the work here. So we're player coaches. So we're running the portfolio, but also doing the research. We're also sharing ideas with the investment committee at Essex, our small and mid-cap team in Chicago. So that investment committee is structured to push and pull, yin and yang, on ideas and idea generation. And so it's a collegial debate. And so, and Rob and I do a lot of that also. So everything that goes in the portfolio is a decision that both of us make. And so we're running a very concentrated portfolio. It's roughly 36 holdings. So we always have more ideas that we can put into the portfolio. So we're constantly evaluating things. So we're doing a lot of work right now on alternative protein. So what's
Are you
the
working
big
with the
idea?
guys at FAIRR with Maria Latini and?
We've seen their research. Yeah. And so, so the other idea is sharing ideas. So I do have a networking group I've put together to push and pull on ideas. It's called the Impact of Beer. I think I told you
Excellent. Is that trademarked? Have you trademarked that?
we haven't trademarked it, but we get together. I think I mentioned I invited you in the past. We'll have to get you there. We've fallen down the last 3 months and haven't done it because of a lot of workload. But I do that with a long-standing former coworker, Mike Lear, and a guy named Bill Davis, who has a startup around impact in Boston.
Excellent. So let's move forward then. I want to pick up on, you referenced the Sustainable Development Goals in some of your pitch deck and your materials. And you talk about quotes, we believe it is high time to move the needle to solutions and frame our perspective using the United Nations Sustainable Development Goals. 16 goals, 16 are active. The 17th one is kind of a wrapping one. Could you unpack some of that? And as you unpack that, I'm going to put a perspective to you. I have adopted the view that the Stockholm Resilience Center and Johan Rockström and Pavan Sukhdev back in the day, they developed from imagery that one of their colleagues had developed, which is more circles or rings in a pyramid shape. Many people think that the SDGs are a smorgasbord. You can it's a flat 2x2 and you kind of cherry pick whatever you want. My view is that is an inaccurate or imprecise way of framing it. It's much more systemic than that. And so you need to rank the biosphere and then the society and then the economy. That's the flow, and you could literally put the 17th one like a little cherry at the top of that pyramid. What is your approach to thinking about the SDGs and how do you perceive them? Do you perceive them as a pyramid or do you use them more as a smorgasbord?
So, Graham, I'm going to ask you a question because I can't see the SDGs clearly. Where is climate action on this pyramid?
It's on the biosphere piece.
Good, it is. So it's on the first level.
Yes,
as it should be. Okay, good. So I would say, let me keep it simple. The reason why I call it moving the needle to solutions is that all of the effort in ESG the last 20 years has been around incorporation of risk. Full stop. I feel really strongly about this. Mm-hmm. And there's a massive amount of cognitive dissonance also. Mm-hmm. So gatekeepers, a lot of people have said, we need to shore up risk, and it's a way to check the box with a thin pencil on. I've done my work. I'm invested in ESG. And
it's a great phrase, by the way. Check the box with a thin pencil. It's
a very slight pencil. Yeah, we've checked it.
No, I got it.
You can't read it, but we've checked it.
Very nice.
So I determined. So 3 years ago, I know we're investing around solutions. And I was making what I thought were okay points about how you could have impact in listed markets, but I wanted to do more. And so what we did is we did a 3-year pretty significant study using a lot of interns, and we've come up with a methodology around impact solutions. My goal initially was to have a carbon offset number in water mitigated for the portfolio, and we're not there yet, and that's just fine. Okay. And so what we've done is we've developed a framework and methodology. And so I said to one intern team we had on, it was 5 interns for a semester, I want you to look at every single metric out there. IRIS Plus, SASB. IRIS Plus wasn't even really around then. SASB, SDGs, what resonates? And they came back with a really good methodology around the SDGs. And I said, aha. And that was before Climate Week in 2019. And I was going around the UN. I saw all these guys in three-piece suits wearing the SDG pin. I said to my challenge, what is that? Well, that's the SDGs. What are you doing about it? Well, we're all about the SDGs. I said, are you investing to them? And so that's what I call moving the needle. And since then, since Climate Week in 2019, think about the amount of aspirational commitment around the SDGs globally. So think about what corporations have done, what governments have done, and what sustainable consumers have done around solving the climate issue, right? Massive amounts of capital aspirationally pledged. So now let's move the needle to the solutions. And so what I want to do is formulate using the SDGs. It's a common language we can use to move capital to true solutions. And so that's why we undertook this. And so I wanted to create more of a framework to articulate how, and then this something called key performance indicators, what's known as sub-SDGs. So each of these SDGs has other sub-SDGs. So what we've been doing, the irony is many times you have a small mid-cap company, they're doing all this, but they just don't know about it. So we have a lot of companies in our portfolio, they don't know what an SDG is, but they own the desalination market. Desal is incredibly energy intensive. We have a company called Energy Recovery Devices that lowers the operating energy usage of a desal plant by 70%.
That's a lot.
Yeah, especially when you're running your Middle East, which is solely dependent on desal, on oil, right? Or bunker oil, right? So it's massive return. Let's start to frame it. So that's what we've been doing, is engaging with our companies, educating them on the SDGs, talking about what SDGs and sub-SDGs they solve for. What I like about the way you framed it with the biosphere is that one thing I learned in COVID, and one thing I love about this is we're always learning, is that there's a lot of complexity when you think about climate. So agriculture is a victim of climate change, but it's also a contributor to climate change. Oh. Water issues, water is an expression of climate. And so all these issues are sort of intertwined. So yes, indeed, I did here are the 9 we solved for, but I believe climate action is the massive pure SDG that we solve for primarily. Mm-hmm. Life underwater, we have one company that helps shark populations. So squalene is derived from shark liver and cartilage. It's an emulsifier for skincare ingredients. We have a company called Amyris that is created using sugar molecules to create the same DNA strand as squalene, but they're doing it in a lab instead of killing sharks. And so that's how we're getting down to sort of how we're solving for impact.
That's incredibly encouraging, and I'll be sure to link that through the show note. I think it's great that more visibility is shown to these opportunities where you're finding the opportunity, executing it, and then companies are able to take that science and then commercialize it, roll it into a business. I want to keep your focus here on the metrics part. So I'm going to ask you to pick up further on, I picked up from one of your papers that I looked at, GEOS themes and quantitative metrics. And this is maybe a moment where you can expand on those 9 themes that you have. I think you described earlier. It's a nice chart. Obviously, this is a podcast, so you won't be able to see it, but we will include it in the show notes. So could you unpack, Bill, the GEOS themes, and then how you went about doing these quantitative metrics? And again, just a sample, not exhaustively, of course, but maybe just give us a bit of a flavor for how you did that and how that plays out for your investment clients.
Yeah, so what we are doing is starting with a framework. So for the company, what are the SDGs we believe this company solves for? Then what are the sub-SDGs that are relevant? And then as we get into the sub-SDGs, we're trying to derive and become comfortable with a carbon mitigation number. So that's sort of the holy grail in these companies. And so when I say carbon mitigation, what I mean by that is that as a given company's services and technologies are deployed to their customer base, how much are they saving as far as carbon for their customers? And there's a company called Hannon Armstrong that, we have very high conviction in their ability with their methodology on, it's called carbon count. And in order for us to get comfortable, we need to go back to the company, talk to the head of sustainability or whoever developed this metric, get comfortable with it. We had one solar company that their carbon metric output number was derived using the EPA estimator, which is an input-output model. And I read a paper on that. I was pretty skeptical. It's like on the EPA website. It's really, but it's actually a really good, I believe, my opinion, methodology. And so we have companies using that. We have companies that scratch their heads and say, we can't possibly get to this. So what we say is, okay, let's start with a case study. Landis & Gyr is one of our European metering companies, and they actually spoke about the engagement we did with them on deploying across one single customer base your smart meters. How much carbon are you saving? So you have to work with your customers. You have to potentially get a model that's vetted by a accounting firm. But that's sort of the level of detail. Or it could be water. So it could be water is another example for our water holdings. But it's all about water savings. And so we've got companies in our water portfolio. There's 5 companies currently, and we're engaging with them on water savings for the portfolio. And then we also look at quantitative metrics. So megawatts deployed for renewable energy, energy efficiency, energy saved. So it's all, we have different metrics that are relevant to the industry and the company we're following. But the key is trying to arrive at a carbon mitigation number and a water mitigation number. In the interim, we've been doing case studies with our companies. And the reason why I'm doing this is to prove to the market that these are companies that as they deploy their technology, they're saving resources. That's what clean tech is. It's saving resources, saving input costs for companies. And we're doing case studies. And every time we write an investor letter, we're bringing up examples of these case studies. And what I'm finding is there's very little pushback on the part of these companies because we're helping them hone their impact message to the market.
You're helping them tell their story.
Yes, exactly. So we can all bring capital into the markets around the SDGs. And that's what I tell them. So.
And are you, when you're watching the faces on a screen now, of course, COVID and so on, and maybe one day in person, but when you're watching the faces of your clients and you're giving them these examples, what are you seeing on their faces, or what questions are they asking you? Were you saying, the number was this high, and because of this technology, the number is now this low?
Well, we only have about 2 companies in the whole portfolio where we have a net aggregate offset number. So the bulk of them are case study examples. And as we talk to clients, they like this move towards high impact methodology. And I call it impact management. It's not impact reporting, because we're bringing management into every step of our process, right? Engagement. So engagement to me is not proxy voting or engaging with a large cap company trying to change their ways. It's engaging with companies that we like because of the solutions orientation to enable them to better hone their message.
It's almost like, almost as you say, and one might expect, it's almost like a small cap strategy, and in some ways, almost like a private equity strategy, short of actually sitting on the board, but where you are actively involved with the company.
We're very actively involved, and also it improves communication with a company. And so I was in an idea lunch. So you go to a lunch with a company, usually IR, investor relations, or CFO or CEO. And this is a couple of years back. And I asked Jeff Eckel at Hannon Armstrong, because there's a lot of young analysts in the room, and there's not a lot of questions. I said, what do you do? How much carbon do you think you can save? And he said, listen, give us enough capital. We can take a pretty significant wedge of carbon out of the atmosphere. And so it's developing a formulaic framework and methodology, but we have to have very high conviction, because you can drive a truck through a lot of more than a truck, you can drive a fleet of trucks through a lot of the estimates that are out there. So we're very skeptical and critical. So we have to get comfortable with that methodology over time. And then that's why we haven't slapped, an ESG score on our overall portfolio or a carbon offset number. And that's why we're telling these stories. And back to your question, it's also because of the fact that people like to hear about their stocks, I believe.
It's a narrative. At the end of the day, it's a narrative. Yeah. And let me pick up that in two dimensions. I want to pick up kind of how you buy, how you literally pull the trigger, and maybe some examples. But let's start off with the more clarifying one, which is the sell discipline, right? Often the hardest thing for an investor to do is to let go of their favorite names when things go pear-shaped, and they really have to grit their teeth and execute on their sell discipline. So your sell discipline I found described as price target met, decline in fundamental assessment, 25% drawdown, warrants reassessment, and shift in investment thesis. I picked that up off your materials. Could you unpack for the audience how does it feel and how hard is it to execute on that sell discipline?
Well, first of all, we'll say that our segment of the market is fairly volatile. So
your segment being clean
small
tech
mid-cap
listed.
Well, so we're doing clean tech investing. Everything is, we believe, commercially viable, right? So we're not buying what I call lab experiments. Secondly, it tends to be small mid-cap, and it tends to be we have a lot of exposure to industrials and technology. So because of that, this segment of the market, more small mid-cap industrials and tech, tend to be quite volatile. There's more volatility than large cap core. So because of that, we sort of live in this volatile time. And so, yes, indeed, there was wind at our backs last year. It's been pretty volatile this year. So we take advantage of that volatility. So when you say 25% drawdown, we have some stocks that have done that in 1 or 2 trading days, right?
Wow.
So what with no change in fundamentals, right? And so there's a massive disconnect, I believe, right now in the marketplace, where all the secular trends are lining up for clean tech. Market is not really cognizant of it. Why? Because the market's got a massive emphasis on mega cap tech, right? And owning stocks where there's a lot of holders. So we're in a really inefficient portion of the capital market. So our thesis on sell is some ways linked. It's in all cases linked to our buy discipline. And so
so what is your buy discipline?
So as we assess what we believe could be a really interesting industry in one of our themes, we're uncovering what do we believe are the leading companies within that theme. And so the differentiator there needs to be predicated on what is the technology? Is it viable as a climate solution? Is it commercially viable? What's the key driver for that technology? So when I talked about Amyris earlier, their key driver is that their costs are coming down for the adoption of their new compounds with their customer base for different ingredients. So what's the key driver? And then we do what's known as modeling. So we take a look at the financial profile of the company. So we're looking at balance sheet issues, but also what's known as the income statement, where we're looking at what's the revenue of this firm, what does the margin profile look like for the company, is it profitable today, when will it be profitable, and we come up with projections on growth and profitability and where we think they will be using a discount rate, so taking where we think they'll be, moving back to the present point in time, looking at the share valuation and seeing if there's the ability to grow over time into where we think they'll be 3 to 5 years down the road.
Okay.
And so that's what's known as valuation analysis. And so, but in order to get there, the company's got to have viable technology, strong management team, strong governance, et cetera. And so we're talking to the companies, and so we're getting really good indications of where we are. We might do work on a company for 1 or 2 years, watch it, move on, come back to it. So that's the key. And so as we think about buying the company, we have a 35 stock portfolio. So we want to buy it. Our average weights are sort of 2 to 3%. And then as a company hopefully appreciates in value, the weight in the portfolio will go up. And then we need to have sell discipline on, where is it relative to what we think is a fair price? And we may reinvestigate and revisit what we think is a fair price for the company. If the fundamentals get better, maybe we'll apply a less conservative discount rate to get to a more favorable trajectory on price goal. So the drawdown question is important. If you have a misperception, we're not so we think about quarter to quarter, but we're really looking out 2 to 3 years. So we don't get incredibly hung up on what do we think they're going to be doing this quarter. We view that as an indicator of where they are on the key drivers in our model. So if the company maybe, especially given input prices are going up, maybe they stop guidance for 1 or 2 quarters, and the stock could be down 20%. No fundamentals changes. You might see us increase the weight in the portfolio to take advantage of that drawdown. So that's an example of buy discipline. On the sell discipline, it could be overvaluation or fair valuation. So a company could be getting to 5 to 6 to 7% of the portfolio weight, and you'll see us take profits and redeploy those into areas of the portfolio that are more fair valuation. We've gotten some wrong. So it could be a company that misexecutes. There's a company that was in the electric vehicle space that had some problems with vehicle testing. And so we use that as a chance to sell the company.
So a quick chance to shout out, what do you do about the F150 Lightning? And I'm assuming Ford is not in your portfolio. 60 seconds. How many F150s do they need to sell for them to be in your portfolio ever?
Yeah, so you could see it potentially. So we have a revenue threshold. So we want to see at least 25% revenue around a theme for them to get there. It has to be there today. Now, for a multinational company like Ford, or it could be a larger cap company in diversified industrials, we could make a strong case for it if it's under, but that revenue growth, I call it the environmental call option. So that environmental business is growing at a really strong compound annual growth rate known as a CAGR. You might see us buy it. We have Ford in our portfolio. So we have Ford in that.
Which part hits the 25%?
So we are investing in battery chemistry, cathode technology, drivetrain management, a company called Aptiv. And so these are companies, and we have another company called Aspen Aerogels, which helps with what's known as thermal runaway. So they are just entering. They've been really big in the energy business, using very high efficiency thermal wraps to save. They keep cold things cold, hot things hot. They're now moving into the battery market and in the process of talking to OEMs. And so that's another really good example of a company. We look at legacy companies where they're in one basic end market and they're taking that core competency into new end markets that are clean tech. And Aspen's a great example. So we've got a number of companies in the portfolio that are helping with the drive towards autonomy and electrification. On Ford, so there isn't an OEM globally that hasn't announced 34 to 40% of their fleet will be EV. They're not getting there fast enough. So especially in the EU. So the standards in the EU are stronger. China's is booming too. And so that move is amazing, what Ford has done. The Mustang is selling quite well. It's bringing in new customers to Ford. I drive a Chevy Bolt, the GM Bolt. I drove a Chevy before. I mean, GM's got a great EV, and this is a great value car that brought me to GM. And so the firms are all recognizing we're not at the tipping point of electrification, but we're getting there really quickly. And so this thing was just more than a cannon shot across the bow, what Ford's doing. And so now with the Silverado, GM's going to have to try to come at parity. And then I worry about some of the upstarts in the market that have potentially form factors that are really interesting. Whether each lunch get eaten by the large OEMs. And it could very well be in many cases because OEMs, as you probably know, electrification of the car, it's a rolling laptop. It's all software and cable, right? And so there's no ICE complexity, internal combustion engine complexity. So in order for the OEMs to create electrification very quickly, they're forming strategic alliances with other OEMs and with suppliers. So my GM car is LG Chem, right? In FT.
Yep.
So the point is that it's really exciting to watch. So the way we're doing it is through a little bit upstream, the suppliers that can help the OEMs position themselves for electrification.
Okay, good. Let's talk a little bit more about holdings. Really interesting. You've already done a good job on touching on some of those. And first up, to be clear, you mentioned high conviction. And I've seen you have some maybe 35 to 45 stocks at any given time. And then you've got this you mentioned 700 plus are kind of on the long list, and then you kind of narrow it down, and then some you look at more closely over quarters or years and so on. Could you maybe cherry pick 2 recent examples of your holdings and help us understand a bit about how they got there and why you like them?
Sure. So what's interesting about these companies listed here is that they resonate with where we believe the clean tech solutions are. And clean tech is so much more than just renewable energy. So renewable energy is a really strong component of clean technology, but there's so much more there. First point. Second point is that I think if you hold this holdings page up to the average large cap ESG fund, there'll be very little overlap because we're investing.
Just run through the names very quickly for the audience.
Yeah. So these are holdings that Graham put up as of September 29th of 2020, representative holdings. And so I'm not going to go through every one of them, but energy recovery is the example that I gave on helping desalination plants with their energy costs. And so what they do through really high efficiency ceramic cylinders is it's like a turbocharger for industrial fluid flow. So what happens is you re-inject what could be a waste source of fluid back into the process. You harness that power, the pressure, it's called a PS exchanger, back into the manufacturing process. So they do this with desal, and they're taking this now energy recovery in to what's known as the ZLD market, zero liquid discharge. So that's water management. And so when you think about water, the beauty of what these technologies do is the form factors are getting what's known as distributed. So you don't need central water treatment plants to the degree you did 5 years ago. So you can deploy these assets at the point of demand. So there's massive issues with water quality in China, and ZLD is now being upheld, the provincial guidelines by the central government. So it's big in the emerging markets. Sonova Energy, apropos given the movement around Exxon yesterday, is founders are Houston-based energy folks that recognize the move to renewable energy, and so it's based in Houston. And so we talked to Sonova recently about stranded workers. So when you think about stranded assets around oil, we're also going to have stranded workers. What I mean by that is, how do we bring oil and gas workers into the new energy economy? And they actually hired 25 oil and gas workers last year for the solar business. Itron is what's known as a smart grid company. So Itron helps utilities with information flow on who their customers are. And so when you think about what's known as the smart grid, so as we introduce more resources to the edge of the network, so think about what I just said about distribution. When you deploy renewables, or you have a Ford Lightning plugged into your garage, you need two-way communication with the utility. And it could be a time of use, so the spot rates for electricity change, given demand supply imbalances because of these new assets being put at the edge of the network. And I'll just give one more. Well, Orsted I mentioned earlier. Generac is a company, you might know them for backup generation. So it's residential, commercial, industrial, using BTU sources, British thermal units sources that were gas, diesel, natural gas, right? So what Generac has been doing in the past 2 years is they've been doing M&A work, so acquiring assets to enable them to now offer gen sets, what it's known as, with power storage and renewables. And now they have new technology to get in what's called behind the meter, so back into the commercial and residential home to help with energy efficiency technology. So they've got this really great what's known as install base, so customer base, and now they're moving into what I believe are higher profitability segments of their business. And what's really interesting, you've heard, we saw what happened with the hurricane season last year. We saw what happened with the freeze up in Texas this winter. We're seeing what's happened with wildfires in California. So the need for making our grid more rigid, coupled with deployable assets at the edge of the network through power storage, is really important. So it's a strong driver, I believe, for Generac. And then lastly, on Cree, it's really strong in the LED market, but now they're moving into something known as silicon carbide. So it's a new chip that enables much more. The chip can operate in more hostile environments. So think about car electrification with greater energy density and the ability to do more cycle throughput. So you can charge that battery using silicon carbide much faster.
I'd love to drill even further, but we're running short on time here. So thank you very much. And again, we will have those in the show notes. So let's end deep dive 2 here with a big question that I face every day, and that's a question of greenwashing. Greenwashing is when there are claims that don't hold up and they're being spun because a company, an investment firm, a human wants to look more green than they really are. So 2 quick questions. Do you agree greenwashing is real? And if yes, how does it hurt the work that you do?
I do think there is greenwashing, yeah, and I think it occurs in many different ways. And so the reason why it hurts is I think it provides, back to my point on cognitive dissonance, is that people can say, oh, clean tech doesn't work, or these companies really don't have solutions. In some ways, it helps us. So I think it hurts ESG, but it helps us because when you get inside our portfolio, these are not companies that are greenwashing. So these are companies that we're in touch with quite often, in our opinion, are really focused on output and solutions. So that's where we can get to the nuance of what a true solution is. And so an input is looking at the company's operations. Output is investing in the solution. That's what we do. So I think that it does help us. What's happening with greenwashing? When you talk about the tagline, how impactful is your portfolio? I believe these technologies are very high impact. So I think hopefully asset owners will recognize what a true solution is, as opposed to, if you hold up some of the climate solutions ETFs, they're the same as the S&P 500 index fund. So.
Yeah, there was one being flagged this morning. It was a Credit Suisse list, but they were flagging the likes of Schlumberger and so on. Whole different story. So let's
You're listening to the ESG and Coffee podcast, hosted by Graham Sinclair. Sie hören den ESG and Coffee podcast. Ihr Gastgeber ist Graham Sinclair.
And then another round of espresso shot questions. You've been a great sport. Grab yourself a sip. You've been working really hard in the interview so far. So this is espresso shot 3 of the 4 segments we have. I as always, look forward to your answers. So here we go. Ready for round 3?
Okay.
Question 1. Do you have a favorite type of tree, and what is it?
I like, so we have, I just planted 3 crab apples. So I don't know what they will look like, but they bloomed as soon as I planted them. They were beautiful. We have a dogwood that's probably 60 years old, which I love. And then when I planted a maple, which is now about 30 feet high, about 8 years ago. It's a red maple, beautiful. So anyway, I like them all.
Excellent. What one book on investing would you recommend?
Yeah, so I do have it here, A Finer Future by Levins. So it's great. It's
is that Mr. or Ms.?
It's Ms. Yeah.
Hunter Levins, yeah?
Yeah, Hunter. And so I believe, so I'm not going to recommend Graham Dodd. I think I get all my big ideas from science books or sustainability or nature books.
Got it. How is your own retirement fund invested?
I have a pretty big slug in GEOS, the strategy I manage, and we're using mostly active. And for some of the large cap assets, we do have an index fund. But I have I'm all in the listed markets. I don't have any private equity exposure, and I'm geared heavily towards equity, probably 80-20 equity to credit.
And no condo slowly disappearing into the Florida Keys?
No condo, no. I do have a place up in northern Maine, but way up. So hopefully we're safe.
I would call that your research facility. So yeah, that's different. Yeah. What advice would you give to yourself when you're 17 years old? What do you know now that you would say to your 17-year-old Bill?
I think that's a great question. So relax. If you follow, and I just said this to my son, when he graduated, I think if you follow your key attributes, goals, and you really focus on your skill set, and you are diligent and patient, I think all will be very good.
Nice.
So follow your dreams, but do it with a plan.
Yeah, and I like the word diligent in that too. What is your advice to people seeking to enter the field of ESG or investment and finance tomorrow?
Well, my advice, it's interesting when people, a student may come to me and they haven't done any work on ESG, right? They want to just be an analyst. And so I think everyone that enters investments needs to think about ESG and manage the ESG. I don't think ESG will ever be fully mainstream. I think there'll always be cutting edge aspects to it, which is what will make it exciting. But my advice would be, really focus on sustainability. It's a mega trend, and the beauty is all the students know it. So when you think about the students, the story I tell, and sorry, this is not expressed so fast, but in order to get an intern 12 or 14 years ago that has sustainability focus in school, I had to go to two schools, Yale School of Forestry or Thunderbird. Today, every single school and university has a significant, not only sustainability program, but sustainable finance program. So the students are all cognizant of it.
Good. All right, let's head to our last deep dive now. It's focused mainly on performance and around the engagement piece, the active relationship. You already hinted at some of that earlier. So just off the top, very quickly, PRI reporting, are you a PRI signatory or a signatory to some other network? And how is that reporting experience for you in 2 minutes?
Yeah, so we're at Essex, we're members of IEN, Intentional Diamonds series, the Investor Network on Climate Risk. We've supported both entities, IEN for about 3 years, and a series I've been involved with for close to 16 years. The PRI is something that I knew would be a heavy lift, so we put off signing until this year. So we signed in 2020. It was a massive undertaking, and I sort of hit it earlier that I think it's kind of biased towards much larger firms. But we're awaiting the results. There are some complexities with the reporting at PRI this year, but we look forward to engaging with them to help us hone the ESG methodology at the firm. So what I mean by that is we're all about ESG. We've mainstreamed it, but help us construct back end, front end, a little more methodology around how we're framing companies. I can talk about outputs and solutions, but just a little more methodology there.
Okay, and then in terms of fund performance or more strategy performance, whatever, in terms of compliance, you able to speak to us?
Yeah, I can't say, but I'm just going to say that we have outperformed our broad benchmark, MSCI World, over time. We have a secondary benchmark, the Wilder Hill Index, Clean Tech. We've outperformed that since inception also. We're in GEOS, we're very concentrated. And so in market environments that are volatile, you might see us underperform MSCI World in the near term. But when the markets improve, we do better. But I also say we're more diversified and broader than the Wilder Hill Index. So we have less volatility than the Wilder Hill.
And then maybe you're the right person to ask. I'm not sure. If it's not, we can skip through. But I consider the search for ESG alpha as a fool's errand. I think it's more complex than that. It's more multidimensional. It's hard to kind of wrap into this discrete little piece over on the side, whether it's climate, more specifically, or ESG more broadly. Would you agree or disagree with that?
I completely agree. It's a fool's errand. ESG de facto, and that's, again, remember my point on cognitive dissonance. It's me, it's dismissing it. Oh, there's no alpha, so I'm not going to do ESG. So the point is we've integrated it because we're integrating the issues into how we formulate a thesis to talk to a company, prospective company, or current company. Now, I've been involved with quantitative studies in the past, and so when I was at State Street, we had our Advanced Research Center run metrics around data streams to determine is there ESG alpha. And as you know from your days at MSCI, that there are certain segments where there is ESG alpha, right? It's happened in energy, it's happened in industrials. But the governance factor was generally an alpha generator. Companies with strong governance, right? It's an ex post kind of assessment, but it does happen. Well, there was just a headline I got this morning. The governance factor works. This is like 15 years later. So anyway, it was funny that it was an academic study in that. So I think it is a fool's errand. We've completely integrated it. But when we look at the, this is maybe a good way to end the interview. When you think about the opportunity around environment and the companies that are positioned for that, we believe that is an investment opportunity. So that the companies that are well positioned for that should be able to outperform the broad market. So that's back to our philosophy.
Okay, and then very quickly on yourself, how do you measure your own performance? What are you tracking for yourself as an investment professional?
Well, we have metrics at the firm, which are garnered on performance. It's a rolling performance, 1 in 3 years, and then we have metrics on how well are we getting notoriety through asset growth in the strategy, right? So lately we've been talking to some prospects, and so I'm measuring myself about, as we talk to these prospects, do they have interest? Will they invest? That's one indicator. How well are we performing in the current market? So my ability to be able to look at the portfolio intraday on a day where there's a massive amount of volatility on the downside and be really comfortable with everything I own and that we have in the portfolio, that's a strong, I think, metric that I use frequently. Anyway, I'll leave you with those 3.
I was on a call before this interview with Singapore, and I was explaining a bit about how 26th of May was a significant day in the space on account of the Shell legal ruling in the Netherlands. It's relevant to the Netherlands, but will probably have implications elsewhere. It will go on appeal and then the Chevron and ExxonMobil votes that happened in the US, and the surprise victory of Engine One's slate of directors, or some of them, with strong backing from BlackRock and others. Do you have a 60-second opinion on how 26th of May was in some way different or important?
I want to give a shout out to Tim Smith at Walden, right? So there's folks that have been in the industry engaging with companies for 30 plus years, 35 years, right? Bill McKibben at 350 sort of has been framing this as an activist for 12 years. So I think there's the success yesterday was laid over 25 years, and so I'm not going to give it all to engine number 1 or BlackRock. I think, but I do think it is what's intriguing. I just talked to my co-manager Rob about this morning. Is that this still isn't reflected in the capital markets, I believe. So you've still got sell side analysts that are looking at energy companies saying these stocks are undervalued currently. I think you could say that, but you need to make sure that these are companies that are truly moving to the new energy transition. And obviously that's not the case with Exxon, right? I think it is the case, I'm not going to name them, with some of the companies that tend to be Euro based. Not Shell. Shell's not on our list, but others. So that's interesting. I think it's the divestment movement gave a lot of attention and focus to what's happening with stranded assets. But I've always been trying to move the needle to the solutions, right?
Okay.
So let's not just focus on stranded assets in old energy. Let's focus on, or divest, but why not reinvest in the new energy economy? So someone in the industry said, Tom Koo, when he was at MSCI, said, Bill, energy doesn't have to be just fossil fuel. So back to how do we, sharing ideas with your peers in the industry. It was just a great, obvious point, but a good point to me.
Sure. And how could you just give me 60 seconds on how does your relationship end with your portfolio companies? And here, let's assume that either the thesis is played out, and we talked in detail about self-discipline earlier. That's not what I'm talking about here. I'm talking about more about you engage with them, you back them because you thought they had a great new technology, or they could be one of these solutions, and so the opportunity you walked into, and then it goes pear-shaped for some reason. How does that relationship end?
Well, if it was, so we wouldn't just wait for it to go pear-shaped, right? We'd be, throughout the time, we're evaluating, our model, where we think they are, and then all the qualitative work in our background and knowing, and there's probably a key metric or driver we're looking at. So there's a lot of examples of companies that are run by engineers. So they'll just spend R&D budget, and not get to the end market, right? So you've had some of that in clean tech. And so, but some of I mentioned the sale we had of the electric vehicle company that the test went poorly. Well, we did a lot of work that we didn't just suddenly wait until that test went poorly. We were, over the context of the 8 weeks, we were doing work on everything that was publicly released on their technology, and looking obviously at the financials, looking at the makeup of the management team, et cetera. And we came to the conclusion of, well, let's wait for this test. And that's the key metric. So it's a stock by stock issue. It could be a company that has issues with commercial viability. So it works in the lab. They have a really interesting technology, but they just can't scale it because the costs are too high and their profitability is eroded. We've had one of those. But a lot of these companies are older line industrial companies that have been around for 40 or 50 years, and maybe there's a turnaround situation within that company. And so it's they're honing. Could be a water company where there's new management to enable them to scale, limit their costs, control their input costs, enhance that profitability, and there'll be a great run for 2 to 3 years in the company. Then you might see us sell at that point in time.
Great.
But we frequently revisit companies, and so it's met our price target. And there's been companies that have met our price target. We bought them back, 9 or 10 months later because of something happened in the dislocation in the market.
Nice. So let's end deep dive 3 with ESG in 100 moments. I'm embarking on this book project, A History of ESG in 100 Moments. It's going to be visual. They're going to be photographs, and it's just kind of your coffee table read, if you will, non-academic. If you had to read through that, you flipped through that, you got to the end and you thought, oh, hang on, Graham, you have forgotten this moment. What would that one moment be that absolutely has to be in there?
Wow. Okay, that's a good one. You stumped me on this one. Well, I think there's a number of moments, so I think you need to.
You can only have one.
Okay, only one. I think you need to discuss the new energy economy in the context of big oil. So the decline of oil, the great energy transition from fossil fuel to clean tech. I think that's very key.
Got it. We'll bank it. Right.
You're listening to the ESG and Coffee podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee podcast. С вами Грэм Синклер.
Right, let's wrap now with the fastest special shot questions, set 4. These are a mashup of the Proust questionnaire and the Bernard Pivot version from inside the actor's studio. Ready? Here we go.
Okay.
Question 1. What is your favorite word?
Focus.
What is your least favorite word?
Pivot.
What profession, other than your own, would you like to attempt?
Teaching.
What profession, other than your own, would you not like to attempt?
Loaded question. Lawyer.
What attribute does an excellent investor have?
Curiosity.
Which living person do you most admire?
It's a little controversial, but Ted Turner.
What is your greatest extravagance?
I have an expensive bicycle.
I pictured that, by the way. Which talent would you most like to have?
Play the guitar.
What do you consider your greatest achievement?
With my wife raising two great boys.
And what is your idea of perfect happiness?
Walking in the woods.
So before we come to my very last question, the Goldilocks question, an opportunity for you to ask a question to the audience, a call to action, if you will, for the power of one. So open question, what action in the investment ecosystem do you want our listeners to take tomorrow, wherever they are, however big or small they are, anywhere in the world? What one thing do you want them to do?
If you have own stocks, listed equities, look at your holdings and get to know what you own and question your holdings.
Thank you. So to the Goldilocks question, Tesla Incorporated is an American electric vehicle and clean energy company based in Palo Alto, according to Wikipedia. One share of Tesla, TSLA, closed yesterday on NASDAQ at $619, up 2.39% for the day. Price earnings ratio, a crazy 623. Is that too high, too low, or just right, and why?
I don't want to answer it. And the reason why is I think there's been too much attention paid to Tesla in the marketplace. There's so much more to clean technology than Tesla. So we have 36 companies. We don't own Tesla that are not Tesla. We have Tesla without owning Tesla. So we have all the inputs to that. So we've owned Tesla at one point in the past. So I'll finally give you the answer, Graham. I think it's probably a little too high.
Got it. You've been a fine guest. Bill Page, Senior Portfolio Manager, Essex Global Environmental Opportunity Strategy at Essex Investment Management Company. You're one of the originals. Thank you, hear it from me, for your hard work over many, many years, making new paths in the practice of investment and finance. I like to say the investments you make become the world that we live in. So thank you for trying to make it better. And thank you for coming on the ESG and Coffee podcast.
I appreciate it, Graham. And thank you for your leadership in the industry and everything you've done to prepare for today also.
Thank you kindly.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
And now a moment of bonus tape with my guest, a moment to reflect very quickly on ground we covered, what we missed, anything we'd still like to say. So over to you, Bill. Anything you'd like to cover or edit or think through again?
No, Graham, I thought you did a great job. I think I didn't. Can I say whatever I want? No. I think the Ted Turner. He was my idol. He still is my idol. He's just highly controversial, but I love what he did to build CNN.
I was hoping you were saying it because of the American bison, one of my favorite animals.
Well, so I'm getting that. And then he's an incredible sailor. He's humble. He's got a lot of humility. Sadly, he's got some pretty significant dementia, right? He's not in public anymore. He was also an incredible sailor, won the America's Cup, back when it was a Corinthian sport, not a professional sport. But he's also this massive environmentalist. Yes. So that's why he's an idol of mine. So yeah.
Excellent. And I was interested in your extravagance. I knew in the moment I asked the question, I looked at you. I thought you were going to say bicycle, but I was wondering if there's not some.
So I have a Willier K2.
Okay.
It's 18 years old. It still looks like brand new. I don't have a lot of skiing is an extravagance.
Well, this is it. I thought you were going to say on the top of some random mountain in the middle of nowhere.
So we have a place up at Sugarloaf in Carabasset Valley, and skiing is an expensive avocation. But my wife and I love to ski together. We have a great group of friends up there. I get criticized from some jokingly that my carbon budget is driving 4.5 hours up to Sugarloaf. One of the benefits, you and I are both blessed to be able to work from home during COVID, right? So during COVID, I was able to spend about 8 weeks up there. And I'd sneak away for some runs middle of the day, or it's hard with skiing because the mountain closes at 4 and there's not a lot of visibility. But so that's an extravagance. And I like to spend money on really good food, so really good healthy food. We have a health food store locally. I actually did a webinar for the health food store on impact. I love expensive hot sauces.
Okay. And I heard, did you tell me you're going vegan, or are you cutting down?
I have gone almost full on vegan, but now I've become flexitarian because I can't kick cheese.
Mm.
Cheese, so there you go. There's an extravagance, which is cheese.
Yeah.
So I'm on no meat, although I cheated up at Sugarloaf. I had a bag burger. They have a cheeseburger called the bag burger, and they put it on pizza. So I had that. So I've had one bit of meat the last 8 months. I'm finding I'm healthier. I've lost weight. It's a win-win.
Excellent. You're looking good.
I'm even off eggs. So I use something called Just Eggs.
Wow.
It's a pea-based egg. And so what's amazing is you think about the input and output of, even think about food waste, right? So some 15% of CO2 emissions from food waste. So it's a massive issue. So I figured let's do what we can. If we can all kick burgers half the time, that's a win.
Exactly. For me, it's direction of travel. Of course, it's velocity, direction of travel, and speed. But everyone can figure it out in their own ways, in their own ratios of what.
And I'm mindful of what farming, especially you're so close to Vermont, is so centric to Vermont.
Absolutely.
There's going to be, but there's a way you can transition to alternative protein as a farmer.
And what question didn't I ask you that you really wanted to answer?
Maybe an outlook. So what do we think today?
Go ahead. Yeah.
And so today, what's our outlook for clean tech? And so we're very constructive. When you think about the market forces at hand, one risk that we have right now is potentially inflation. And so when you think about inflation, which is caused by price friction, so it could be excess demand for workers or excess demand for goods. We're seeing it now with commodity prices. So the key is how much of this is due to reopening after COVID, and how much of this is structural in the coming cycle. And I think it's both. But the benefit of clean tech is that clean tech de facto helps control input pressure. Once you get your inputs, it also helps control your manufacturing process and your outputs. And so we have a lot of exposure in the portfolio on using less resources. Once you're building or manufacturing goods and services, controlling your input costs in the factory, manufacturing optimization through robotics, and then what's known as asset tracking services. So as you ship goods, optimizing to lower the price and make more resource efficient goods and service delivery across the economy. And so all the way from construction of buildings, we have technologies that help optimize that, to shipping goods and packages and helping the smart city run faster. So that's a major trend. The second question could be on our outlook for government policy. And we're constructive on what we're seeing in Washington. You mentioned the 50 states. Sort of you have different state level, even state and local practices. It could be on electricity prices. It could be on water or feed-in tariffs or renewable energy standards, RPIs. And so what's really interesting is that we think that you'll hopefully see less friction on that in the markets with the current administration, which could help. But back to my point is that these technologies are off on their own footing given costs and demand in the marketplace.
So just on that, I had one piece. I was talking yesterday with an old colleague I knew from UN Environment Program days when I was helping build out the PRI in Geneva, Switzerland. And the conversation got to distribution. And effectively, there's a distribution problem in as much as it's very hard to bring in new clean power because the whole distribution system is either antiquated or not ready for that. And do you have 60 seconds on the distribution and where the investment opportunities could be?
Yeah, it's a big issue. So there's been, we saw it with Texas, right? And so we need massive amounts of spending. So clean tech, when I talk about edge of the network, so you're deploying resources, it could be energy efficiency technology, or it could be stationary storage, or it could be both at the point source, at the source of demand. When you do that, there's a sort of a school of thought that you don't need electrical grid anymore. Well, no, you need more of it because it's two-way intermittency and communication. Then we need to have digital pricing. So you move to think about sort of the IoT. We'll think about bringing that to delivery of electrons for electricity. So in order to fully go carbon negative, in the next 30 years, let's call it. Let's be conservative and say 30, not 20. We need to be fully electrify our economy. So we're only able to get halfway there with renewables. And so the other half, I hope, will be hydrogen. And so as you deploy these green electrons and electricity methods globally, we do need an electric grid, yes. And so utilities, there needs to be some regulatory work that's done here, but it is a massive issue. Now, even with power storage, so people are working on solid state batteries so we can store excess supply of renewables, whether it's wind or solar. We still need a grid to deliver that power storage to the demand centers. And so it is really key. So I'm a big believer that yes, and we have exposure in the portfolio around grid electrification. When you think about my electric meter examples.
Okay, great. Well, I hope you enjoyed our long-form interview with Bill Page of Essex Investment. That's the sound of someone fully committed to his life's work in investment, and who's enthusiastic despite taking some lumps along the way. Respect. Here's my 3 high points from the episode and some of the things I found unexpected. So high point 1, I respect Bill's pitch that every investment has impact, and his argument that he can be an impact investor with a listed portfolio. He even argues it can be more impactful. I find that very interesting, especially coming off the excitement of what happened on the 26th of May at the annual general meetings of Chevron, and most famously around ExxonMobil, when engine number 1 got some of their members onto that board. Bill describes, quote, how impactful is your portfolio, unquote, is one argument he's found traction with as he's looked to explain his strategy when he's been asset gathering. And usually he's investing in an all-cap strategy. He's investing in any size company that meets his other thresholds, and is listed on exchange with $100 million in revenue and so on. And that is profitable from day one, where they go ahead and buy them. So that's none of those crazy electric vehicle IPOs, for example, that ran up at the end of 2020. And I like the way he phrases this question. He's looking for the next Ørsted or Tesla. I was surprised to hear his answer on that Goldilocks question. High point number 2. Clean tech investment theme is so much more advanced in 2021. His white paper that I'd missed, quote, disruptive tech does not care who is in Washington, unquote. He wrote in 2017, and he reposted that to LinkedIn in November 2020. Check out the show notes. And the argument is that clean tech does not need federal level support because clean tech 3.0, starting in 2019, is already here. It's becoming the lowest cost option. It's making life easier. It's saving resources. It's helping commerce run smoother and makes life more enjoyable. Clearly, I would think that a tailwind never hurts, but it's useful to hear his framing, which also reflects the investment power and that's available at the state level, and also how the major investors are now moving. The market has clearly come around to investing in solutions. It was interesting, that anecdote where he spoke about having to explain sustainability and the climate problem, and now he can just go into a meeting and go ahead and present his solution and argue about the merits. And fortunately, he's no longer talking about Solyndra. Third high point for me is the best way to learn is to build it yourself. Essex Investment has no black box. They have humans looking to make the investment decision, filtering through these different potential investments. 700 odd companies they have on their long list, and they shrink that down to 35 to 45 to fit their dynamic growth trends. You would have heard Bill with his alternative take on the availability and utility of ESG data. That must be potentially provocative listening for people in the ESG research space, service providers. And Bill's view that ESG data does not exist for what he does. I agree with him around small cap and mid cap. I'm a little surprised he would suggest that for large cap. But clearly, as an active manager with a concentrated portfolio, he likes to really roll up his sleeves and get his hands dirty, meeting with CEOs and understanding the company in greater detail. And Bill's argument is that the GEOS edge comes from asking different questions and collating data points from which to analyze companies, sometimes tracking the candidate portfolio company for years. That's quite an investment. So to some unexpected items for me. First up, Bill makes that distinction between climate tech and clean tech, and he has not yet at least chosen to develop a sister product or strategy to sit next to GEOS, or more specifically fit into the taxonomy of what is climate finance, which in itself, almost as a specialization, has got a big tailwind. Maybe that's a missed opportunity, I'm not sure. I also expected Bill and GEOS to be running a shadow CO2 equivalent per ton pricing climate pollution, and to have shaped Essex Investments' own approach across their other strategies, but that hasn't yet happened. Instead, we got the detailed explainer on the most fungible markets, the European Union, and it was fair to hear Bill's complaint about how long we've been waiting for CO2 equivalent prices since 2006. I think I remember some of those conversations in a skyscraper in Boston back in the day. I also learned what the US phrase, quote, peg the dial, unquote, means. So I hope you appreciated the interview. This is what a high-quality conversation on investment and ESG sounds like, and I hope you can join me next time on the ESG and Coffee podcast. Live hopefully, work optimistically, and grow the pie in 2021.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment, strategy, and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.